Today is Tuesday, February 23rd. I want to take a look at log scales versus linear scales. There's always a big argument about that. And when do you use which one, and why would you change, and which one should you believe if the two trend lines you might draw don't agree? Here's a chart of Amazon for several years. You can see the 2009 bottom down here and then start of the rising trend. And that trend line on a linear chart, that's pretty clear. But then things get different around 2015 when obviously the stock takes off. So this trend line, believe it or not, is just not useful right now. It doesn't help you do anything in terms of buying and selling over the last year or so. Let's just take a look and let's just put a simple trend line right up there to describe the action. And that makes sense. That's really the one that everyone should be using. And obviously you can see it's broken to the downside. So let's now flip this over to a log scale and see what it looks like. Now you can see that the trend line actually has a little more value. It's a little closer to the action. If we were to take a parallel line and draw it here, and we can see that would be a channel. Over in this area, of course, the argument would be that the trend line wasn't useful, but that's not where we are now. We're over here in 2016, and the trend line is once again coming into view. Now look where it is coming into view. Let's put a horizontal line there so we could see. It's in around that area if the stock falls at the current rate. If we put it back to linear, it looks like it actually bounced off that supposed support level. So perhaps Amazon is not going to be cratering. It's not going to be going too far lower. Maybe it's going to test that level again just under 500. Anyway, it's just a difference in using the log versus the linear. Which one do you believe? And you have to really switch back and forth. Why on this particular stock? Because look at the price range. Down here at 100, up top at 700. It's a huge percentage move. And over time, it's probably a better idea, probably better analysis to have a log line. Let's check out some more things. This is something I put in my Barron's column on Monday. This is the copper ETN. It's like an ETF, only it has an N at the end. There are differences, but for our purposes here, it doesn't really matter. You can see that the line drawn from the peak in 2011 through that first reaction, and then it hits down here in 2015. That's a pretty good line, and this is a linear scale chart. But here's another line that's possible coming from early 2013. So which one is better? Now it doesn't look like much of a difference in this particular chart, but it's a great example of how you can look at lines and figure out which way to look at the market better when we flip this into log scale. And look at that. The two lines are pretty much on top of each other. Now, I know there's a little error up here. We could actually fix that by just bringing it down into there. And then it's still a pretty good line. And just to show you that, I'm not making this up, there's the original, and then back to log. You can see this is probably the best way to look at this ETN over the long term with a linear scale chart. Now if you're looking for day-to-day charting, you want to put it into a daily time frame, that's great. Come down here, and now you can see the difference in perhaps the top of this trend to the bottom. It's big, but it's not quite as big. Let's see what happens. Let's put some lines on. Now that's an arguable line, a little subjective. I'll leave it right around there. So it has not quite broken out in the short term, but you can see a pattern, possibly a head and shoulders over here. But that's not why we're here. We're here to look at trend lines. And now let's see what happens if we flip it to the other format. So in linear format here, this line would probably be better if it were there. So that tells me because of the price change from 35 down to 22, that's pretty big, and we want to stick with log scales on this as well, even in this shorter time frame. Okay, let's put this back into weekly. We'll take a look at one more. Everyone loves the S&P. The data come in. All right, here again, we have a long-term chart and two possible lines that might be drawn. Now here's the one from 2009. Now I've taken a little technician's license by ignoring that spike low there, And you'd see that if we put this in weekly close format, it would be a pretty good line. But the reason I like the line is because it hits the market many times in this area here, here, here again, and both times last summer. So in the linear format, this trend line looks great, and it's broken to the downside. At least it appears to be broken to the downside. Obviously, it's being tested now. This other line was a decent line up until the time it was broken. But now, because it's broken, because there's another trend line that we can use, maybe it's not the best line to use. But let's see what happens when we flip this into log. Look at that. So again, this proves that looking at a log scale trend line for these long-term, very big moves, and you can see obviously, the S&P down here, what was that, 666, way back when, up to over 2,000. So you want to look at this line. This is probably the better line to be looking at, and it's not so much to figure out which line is best, but what the trend is. And to me, based on this linear and log scale charting, mostly the log, the trend, the bull market did end in the middle of last year. And this rally that we saw late in the year was a test of the breakdown. So to me, this tells me that the trend is to the downside. Of course, I'm not going to make a market call here, but it does look like the major trend is broken, and that's how we frame the market. So again, the key to remember is the bigger the price difference in the beginning and end of the trend, the more likely you're going to want to use a log scale trend line.